Well, welcome everyone. Um, Today's new farmer webinar is talking about farm taxes with Mike and Kelly from UNH. So before we get started, I just want to share my screen real quick. And that is my email. Sorry. But didn't we just talk about this? Okay. So I wanted to show that, and I closed it. All right, so here is our new farmer website here at the University of Maine Cooperative Extension. And this is a place that you can find information about all the different programming that's happening in Cooperative Extension, as well as around the state for new farmers. So this is the section called Build Your Skills. There's Learn with Us and Learn with Your Own. Learn with Us has in-person as well as webinars like this. Learn on Your Own has resources that you can find. And so you can go in there and look at different categories of things that you want to learn about. And this right here is our calendar. And all of our stuff is on here, as well as things from other organizations as well, like the Department of Agriculture and like MOFGA and Maine Farmland Trust and a lot of different entities. So I just wanted to point that out, and I will put the email address to this right in the chat, and I will also put that in an email out to everyone after the webinar. So I'm Chris Howard, and I run the Maine New Farmers Project, and that's who is putting on this webinar today. And we are funded by the USDA NIFA. So I just have to say that. And I also want to welcome Mike and Kelly. So Mike Sciabarrasi was an extension specialist professor for cooperative extension at the University of New Hampshire for 36 years. During that time, he led statewide educational programs and agricultural finance, farm business planning, estate and succession planning, and risk management. He also served as an interdisciplinary leader for the New Hampshire Agriculture and Natural Resources Business Institute, and taught undergraduate courses in business management and agricultural finance in the College of Life Sciences and Agriculture. Since retiring, Michael continues to support state and regional extension programs and farm business management. Projects include the New England and Northeast efforts to establish benchmarks for diversified direct market farms, evaluation of farm financials under the New Hampshire Farm Strong program, and income tax education for farmers in New Hampshire and Maine. Kelly McAdam is program team leader for UNH Extension's Food and Agricultural Program team. She worked as an agriculture business management field specialist for 12 years, specializing in farm taxation for the past 4 years. Kelly holds an enrolled agent license with the IRS. Welcome, both of you.
Thanks, Chris.
You're welcome. Thanks for coming.
Right, so I will kick things off here, and I'm going to share my screen. See, there we go. And that should be... Can everybody see that? I'll put it into slideshow view.
And Kelly, as you're setting up your presentation, I just wanted to mention, if you have any questions, feel free to put them in the chat, and we will make sure to get them out to the, if it's time pertinent, then we'll interrupt the speaker, and if not, the speaker will get to it when they're done speaking.
That sounds great. Thanks, Chris. 1 second, I sort of pull my notes up real quick. Everybody can still see the slides okay? Okay, just let me know.
It's not in the presentation mode.
Okay, I will switch that back. Beginning, there we go. Okay, so today we're going to talk about filing your 2023 farm tax return, which is done through the Schedule F. And we just wanted to acknowledge that these presentations are funded by a USDA grant called an Ag FTAP grant. And at the end of the presentation, we'll talk a little bit more about some resources that are available to you in your education on farm taxation, and that might be helpful when you're filing your own tax return. So today we're going to talk about, first of all, defining farm and farmer according to the IRS. And then next we'll really dig into the Schedule F, which goes with your Form 1040, your individual tax return. And we'll also talk about other forms that are commonly used by farmers. And then wrap up with talking about the importance of farm records and tax preparation tips. And then, like I said, we'll have some additional sources of information to share. So starting off with what is farming, and this is a very defined term with the IRS. So farming is defined as planting, growing, and harvesting horticultural commodities and breeding, raising, and producing livestock and animal products. So this may include on-farm drying, washing, packing, grading, and storing of commodity or products in its unmanufactured state. So what does that mean? Well, if you have an apple orchard and you are growing those apples and you're selling them, that clearly is farming. If you are taking those apples and you are turning them into jellies and jams or some type of cider, that part is not considered farming. So that's a different way of filing your income from those types of activities. And so what's a farm? So that is, it encompasses livestock, dairy, poultry, fish, truck farms, as well as nurseries, orchards, and greenhouse operations. And there's things such as like maple syrup. So producing or collecting the sap from a maple syrup operation is considered farming, but taking that sap and boiling it, bottling it, that part is considered processing, which would not be considered a farming activity. So who's a farmer? So you're in the business of farming if you cultivate, operate, or manage a farm for profit, either as an owner or a tenant. And a lot of times, or a common question is, well, am I a business or am I a hobby? And recognizing that beginning farmers are going to have some negative net income, meaning you're going to have losses, especially your first few years. So if you are the IRS has kind of 9 criteria that it looks at to make sure that individuals are operating a business versus a hobby and not just trying to take deductions for hobby expenses. So it's important that you're showing you're meeting those criteria. And so I also just want to say with hobby income, you can't deduct your expenses beyond what it costs to produce that, to the cost of goods. And Mike, if you have a better way of saying this, please feel free to jump in. So you couldn't have a loss from a hobby activity and claim that loss on your tax return. So that's important to know. You also don't want to come across as having passive activities, meaning you're not actively participating as a farmer. And I'll talk more about that in just a bit when we get to the Schedule F. So the Farmer's Tax Guide is updated each year, and that's a really good resource. So you can just Google, IRS Farmer's Tax Guide, and you'll get the 2023 guide will pop up right at the top. And again, this is a really great resource. It certainly has any updates to any farm tax laws, but it also just goes through line by line of farm income, farm expenses, a lot of the issues that you're going to deal with as a farmer and filing your taxes. Another good resource is the instructions for Schedule F as well. And you can get that either you can Google it and you can go to irs.gov and also get that. So Schedule F is broken down into sections. And so Schedule F is filed by individuals, partnerships, LLCs that are filing a return as a sole proprietor or as a partnership. It can also be used as a corporation can use a Schedule F to include as kind of like an addendum to their tax return, but it really is called a Form 1040 Schedule F. So it's like an additional page that the bottom number that you come out with, meaning your net income or your net loss, gets carried to your 1040, and that gets shown on the Schedule 1, which is your income, breakdown of income. So back to the Schedule F, there's the front page has two parts, which one part is farm income using the cash method. And part two is documenting your farm expenses using the cash and accrual. And then that allows you to arrive at your net farm profit or loss. The back page, which is part three, which is farm income for the accrual method, and I'll talk more about the difference between the cash and accrual in a moment. And it also has your agricultural activity codes on the back page as well, and I'll talk about that next. So at the very top of the Schedule F, you have, the name of the proprietor. You're going to put in the principal crop or activity, the code, which is the type of farming activities, and that's from the back page of the Schedule F. Your accounting method. So this is whether you're going to use the cash method or the accrual method. So cash method is you are documenting your income and your expenses in the months or the times of year that you actually receive that payment or make that payment. And the accrual is you are accounting for those income and expenses when you make the sale. So for example, if you, for income, if you allow a customer to pay you on credit and you sell them something in, let's say, November, and they don't actually send you payment until January, the cash method would say you're going to account for that in January because you didn't actually receive the payment until January. Where the accrual says you recognize the sale when it actually happened, not when you received the money. So that would be in November. So you can see how the difference between the two. And this also dictates what part of the Schedule F you're going to use. So most farms do use the cash accounting method for their taxes. And you can't just switch back and forth from year to year. If you're going to go with cash or accrual, you'll have to stick with it. Other parts of this section are your employer ID number. And then this is the part I was just talking about, whether or not you materially participated in the farming activities. So if you check off yes, then you were farming as a farmer. If you check off no, you are not participating. Let me just move this out of the way so I can make sure. Yeah, so if you check off no, then your farming activity is considered passive, and there's rules for how much you can deduct for losses. And the IRS is pretty strict about passive income and claiming expenses against that passive income. So you just want to recognize that as well. And then finally, did you file the required Form 1099? So if you made any payments to any service providers that's not a corporation, and you paid $600 or more to them, you are required to file a Form 1099 and send a copy of that to the service provider. So part one is farm income. So using the cash method, and like I said, that's the cash method is the method that's most often used by farmers. And so here we have the sales of purchased livestock and other real resale items. So if you're raising, you're buying in calves, for example, you're raising them for beef, or you're raising those calves and you sell them. So you're purchasing and then you're reselling them. So those are resale items, or you have a farm stand and you're purchasing items from another farm to sell in your farm stand. Those sales would be documented here. Section 2 or line 2 is sales of livestock, produce, grains, and other products you raised. So that's a pretty, encompasses most or quite a bit of farming activities. And then just going down here to line 4A, because this is a very common one. So income from agricultural program payments. So if you've ever participated in any NRCS programs and received money for those programs, you will receive a Form 1099-G in the mail, and that income is taxable. So this is where you would report that. Let's see what else. We've got commodity credit corporation loans. So some of these other things are probably not as common for new farmers, especially. Line 6, crop insurance proceeds and federal crop disaster payments. So if you received any money from your crop insurance carrier, or you were able to file for a crop disaster payment, that is taxable and that would go here. Line 7 is custom hire work. So that would be if you have just part of your farming activity is you are, maybe baling hay for somebody else, or, doing some mowing for someone else, that income would go here. If that's like your primary business activity, that would not be a Schedule F income. That would be a Schedule C. So that's kind of it's the small part of your farming activity that would go here. And then finally, it tallies at the bottom here for your gross income. So just another note about sales. And so this is the one where I talked about the sales of purchased livestock and other resale items. So the sale amount, you'll take the sale amount and subtract the cost of those items to get the net sales amount to report on line C. And then with line 2, the sale of livestock, produce, grains, and other products raised. Again, this is the cash method, so you're going to put the amount of income you received from that sale when you received that income. And then I already talked about the agricultural program payments, and just briefly glossed over the crop insurance proceeds. But again, you're reporting this on a cash basis. You want to make sure you're only including those payments when the check is received. The custom hire work, as I mentioned already. And then there is line 8, which is kind of a catch-all category. So that could also involve, breeding fees, like if you do some breeding for a fellow farmer, or you rent out some of your machinery, or you do some bartering. That is a taxable activity, and you want to report that as the market value of that barter. So for example, if you are bartering, the use of your tractor, and the person you're going to borrow the tractor, they give you, bushels of sweet corn or something, the market value of that corn is going to be your income for letting them rent your tractor. And then income not reported on Schedule F. So if you sell any of your machinery or equipment that's used in farming, that is not reported on the Schedule F. or you sell any real estate, your farm, any part of your farm or building structure, if you sell any of your breeding, your dairy, or your draft livestock, that's not farm income. Because all of those are assets, and those would be capital sales. Farm loans, if you receive a loan from a bank, for example, that is not income. That's considered debt. Investment income also is not reported on Schedule F. And then again, if you had, like I talked about, if you're doing some custom work as your main farming activity, that would not be farming activity. That would be a Schedule C income. So like your main primary job here is to do, baling hay for other farmers, and you're not doing any other work, farming activity, that would go on Schedule C. And then rental income. So if you're renting out any part of your farm, there is another form for rental income. And then over to Mike for farm expenses.
Thank you, Kelly. Can you guys hear me all right? Hello?
Yep. Yep,
Okay.
can hear you.
Great. Okay, so let's talk about the expenses that you can take against your income and see how we determine net income on a farm tax return. So if you take a look at part 2, you'll notice that these are what IRS considers sort of the ordinary and necessary expenses that you have to pay when carrying on your farm business. They're pretty self-explanatory, many of them. You might not have some of them. Very few people have information on all of the lines. The expenses, if you'll know, they're listed alphabetically, and they may not be the same order you have in your QuickBooks or any other accounting system when you're preparing out your P&L. So just kind of keep that in mind. But a lot of these categories are pretty straightforward and easily understood, where others need a lot more information. So let's move on. Next. Sorry, Kelly, I used the wrong term. So let's take a look at farm expenses that are related directly to crop and livestock production. So these are, pretty straightforward. The chemicals you use with respect to production. Conservation expenses are going to require a little bit more explanation. Your feed costs associated with your livestock, fertilizers, and lime. You do have some options on the fertilizers and lime in terms of if you think the benefit will last multiple years. You do have the ability to spread them over those multiple years, but most people take the fertilizer and lime expense all in the year that they pay for it. Freight and trucking, seeds and plants, supplies, vet breeding, and medicine. So you're all familiar with most of these types of expenses. Let's quickly just talk about the conservation expenses. So those are expenses for soil and water conservation or prevention of erosion of land in use of farming, or expenses related to trying to help endangered species recovery. These expenses are deductible only if they're consistent with an approved plan by NRCS or the other appropriate, or a state agency that's equally appropriate. And I'm not sure if there's one in Maine. I don't think there's one in New Hampshire. When we look at those conservation expenses, there is a limit on how much you can deduct, and it's limited to 25% of your gross income in the year that you have those expenses. But if you have more than the 25%, you can carry it over the amount you didn't deduct to later years. There's another interesting aspect I think most of you know about, is that whole issue around prepaid farm supplies. So most of you guys are going to be reporting on a cash basis. And what Kelly said was you get to deduct the expenses when you pay for them. as opposed to when you actually use them in the production of your product. So expenses like feed and fertilizer and seeds and plants and supplies and chemicals can be deducted even if you don't use them. So a lot of folks, when they have a good year, what do? At the end of the year? They buy extra fertilizer and they set it aside, or they might buy extra supplies so that they can bring down their taxable income. You need to be careful with that. There is some limitations with respect to it, but they're not very limiting when you come right down to it. They're limited initially to 50% of all your other expenses associated with farming. So that's not a very big limitation. And even if you bump that limit, if you're what's referred to as a farm-related taxpayer, that means you live on a farm, or you're actually a farmer, or you're related to somebody who lives on a farm and is a farmer, then if you had prepaid expenses of more than 50% of your other deductible expenses, that 50% no longer applies if it's due to unusual business conditions or the prepaid expenses in the prior 3 years was less than 50% of the other expenses. So you can see this is a lot of flexibility here, and you can get these prepaid farm supplies pretty high up there if you really need to. Be careful, though. I mean, this can come to bite you later on, because when you're looking at trying to manage your taxes over time, if you took a year where you bought a lot of supplies and you had another good year the following year, you might end up in a higher tax position. So be careful. And when you do prepay feed, there's 3 conditions that have to be met. It can't be a deposit for the feed, it has to be for a business purpose, and it can't distort your income. Now, those are pretty flexible and open to interpretation, but be aware. Next, Kelly. If we take a look at these lines, line 10, 19, 20, 21, 24, 29, and 30, these are business expenses which also may have a personal cost tied into them or related to them. So if you have insurance and you have insurance associated with your business or in your home, casualty and theft, and it's all put together in a group plan, you have to be able to separate the part that's actually applicable to the farming business and not to your home. So allocation is necessary for some of these things. That would also apply with regards to your mortgage interest. If your mortgage interest also had your home involved with it, as well as your farmland, as well as some woodland, which would be considered an investment property, you have to be able to allocate, use some kind of reasonable method of allocating what portion actually belongs on your Schedule F and what portion goes elsewhere. Taxes, same thing. Just be aware. There are some things that don't belong on some of these lines, like with respect to insurance. You can put, all the theft, casualty, and liability insurance, and you can actually have accident and health insurance for your employees, but not insurance that you pay for your family as the farmer. That gets deducted elsewhere. With respect to taxes, you can have any kind of business property taxes on here. You can have taxes associated with some of your equipment for highway use or that type of thing. Also employment taxes if you have employees that you paid. But you cannot put the taxes you pay to IRS on your behalf for self-employment here, because that's not a deductible tax as far as Schedule F is concerned, nor can you put taxes that you pay when you purchase capital assets like machinery or buildings or real estate. If you pay any of those kind of things, those don't get deducted as expenses. They get added to the basis of the property and you recover those elsewhere, even though they might be farm property. Now, there is special rules with regard, and most of you probably know that there are special rules with regards to car and truck expenses. Generally speaking, if you use a car or truck in your business, you're supposed to be able to keep track of total miles versus business miles. And the business miles, you can deduct the expenses, actual expenses, the percentages associated with running those cars and trucks, or you can use the automatic mileage allowance, which is 65.5 cents per mile for 2023. Now, if you're a farmer and you use that vehicle primarily in the farming activity during the business day and connected with farming, you're allowed what's referred to as a safe harbor rule, and you don't have to keep track of the total miles and the miles spent in business. Instead, what you can use is 75% of your total miles. Again, you have to, that's a safe harbor rule for farming, and that car or truck has to be primarily used in your operation. Okay, next. On farm expenses, the other couple other items we want to separate out is we want to try to make a distinction between two expenses, custom hire and labor. So a lot of folks say they hire independent contractors, and they do, because what they're doing is they're hiring an individual to do a specific kind of job, and they don't control how that work is done. They're just primarily focused on the result of the work. And in these situations where the labor cost paid to an independent contractor is $600 or more, and they're unincorporated, okay? They're an individual or a partnership that's unincorporated, then you need to file a 1099 information form with the IRS and provide one to that independent contractor, so that you can claim the expense and they can report it on their returns. So labor hired is the other expense that you kind of compare. They're kind of similar to independent contractors, but now with labor hire, if you have an employee, what you're doing is you're controlling not only what the worker does, but how the work is going to be performed. And you have sort of what IRS refers to as a continuing relationship with that individual, and you might even reimburse some of their expenses. So with employees, there's a lot of sort of information you have to initially get in line, the I-9 form and a bunch of other things. Not a lot of time here to address that. But basically on line 22, you're deducting cash wages to the employee. And these are gross cash wages, even though that you might have deducted some of that for deposit to Social Security Administration or federal government with respect to the self-employment taxes or the employment Social Security taxes owed and FICA taxes. So as I said, you'll need an employer identification number, as well as getting correct employment forms, and you're going to have to withhold those payroll taxes, Social Security and Medicare taxes, and possibly income taxes, and file employer-employee tax forms. Now, you can have a child or your spouse as an employee in the farm, but it has to be what's referred to as a true employer-employee relationship. In other words, they're not just being paid because they're your spouse or your child, and they're doing comparable work for a comparable pay that you would do for pay to anyone else, regardless of that relationship. Okay, next. Another kind of interesting thing we have to be careful about with regards to expenses is how do repairs compare to depreciation. And when we talk about repairs and maintenance to equipment, machinery, buildings, and fences, we're not talking about any construction. We're not talking about restoring or improving that property or even adapting it for alternative use. Those are considered capital improvements, okay? And they typically have to be recovered through depreciation. There is now a safe harbor rule associated, which you can elect. It's called de minimis safe harbor rule with respect to repairs. And what that allows you to do is if the repair, which is $2,500 or less, So it's pretty good ceiling. You can claim that repair, even though it may be kind of one of those iffy things between whether it's capitalized or not. You can claim it as a repair. If you do that, you're supposed to attach a statement to your tax return explaining why, or explaining why, and stating that you are using a de minimis rule with respect to this repair cost. Depreciation, on the other hand, is how you recover investment in property or improvement in that property or constructions associated with that property. So any kind of property you have in farming is eligible for depreciation if it has a useful life of more than 1 year, that useful life is determinable, and it's used in your business. So when we take a look at our farm property, one of the reasons why land is not depreciable is because it does not have a determinable life, okay? But on the other hand, our farm buildings do, as well as our equipment, as well as some of the breeding stock we might purchase and use in the operation. Our home is never depreciated because, unless you use it for business use, because it's personal use property. Your timber is not depreciated, typically if it's held as an investment or that timber land or anything associated with that activity. Now, there are a lot of different depreciations which you can choose, but you have to choose the options as prescribed by IRS, and we'll talk about that in a moment. When did depreciation start? Well, in the year that you bought it, like a piece of tractor, like a tractor. If you bought a tractor in December, even though you might not use it until next May or June, because it's available for use, it's depreciated in the year that you bought it. On the other hand, if you started to construct a heifer barn and you had part of it constructed or the foundation laid in December, and then the rest of it wasn't built until January and February of the next year, what would happen is that amount that you spent in December would be carried over into the basis of the property, into the additional cost you expend in January and February, added to that cost, and depreciation would start next year, not in 2023, not in the year that you push the foundation. So placed in service is one of the terms they use, and it really means ready and available for use by the farm, even if you aren't going to use it at that point. Okay, Kelly. When you depreciate farm property, you got a bunch of different choices. We've had bonus depreciation or special depreciation allowance for a number of years now. And you actually are required to take bonus depreciation or special depreciation allowance unless you elect out. And what that's done now is for 2023, it was 80% of the cost of the property, or the basis in that property would have been claimed in that first year. In 2024, that drops down to 60%. And this is for property that's called 3 to 5 year classes. So remember, if you don't want to take bonus depreciation, you bought some property, you have to choose to elect out, and you have to attach that statement to elect out of special depreciation allowance to your tax return. Why might you not want to do special depreciation allowance? Well, you might not have sufficient income to offset that depreciation that you're trying to take all in that 1 year. Or same thing with regards to Section 179 expense. Section 179 expense is another method of quickly taking the cost of depreciable property in the year that you buy it or you construct it. And for 2023, the electable amount is $1,160,000. So, so most people would be, that's way and far above what most people would require. But that's another way of quickly advancing depreciation. And if you want to claim it all in the year that you acquired that property and it was placed in service, you can under Section 179. The other two types, MACRS, GDS, and MACRS ADS, are really the types of depreciation that kind of spread the cost of the property over a longer period of time. Okay, Kelly. And the only way you kind of try to start to understand this and what you have for options is you're going to refer to a table similar to this. This is in the Farmer's Tax Guide. So if you walk down that list, you'll see that the first thing is agricultural structures, single purpose. So these are your, heifer barns, your milking facility. Could be your greenhouse operation, provided you don't have sales in it. Single purpose. And as far as they're concerned, as far as IRS is concerned, the options you have on the GDS for how long that property will be depreciated is 10 or 15 years. 10 is the GDS stands for Generalized Depreciation, I think, system, and ADS is alternative. So the ADS spreads it out over a little longer period of time. If you go down that list, you'll also see that farm buildings that are general purpose are 20 and 25 years. New machinery is 5 and 10 years. And fences is 7 and 10. You can look at the rest of it. Some of the stuff with regards to dairy cattle are up there as well. And these are dairy cattle that you purchase. Same thing with other kinds of breeding animals. So all property falls into one of these classes. And once you identify the class, then you can think about what method of depreciation you might take and what period of time you might be able to we would like to use it over. Again, the ADS is used to spread it over a longer period of time, and you want to preserve some of those costs to later years to deduct against anticipated higher income as you grow your business. So next, Kelly. So I just wanted to give you a quick example. This is a high tunnel. And if you put it in use in 2023, here are some of the options that you might have for depreciation. It's only a few. There's others because there's different methods under the GDS as well as the ADS systems. But you could choose to deduct all of that high tunnel expense in 2023. If you had a big income year and you're still growing that business and buying capital assets, that might be a good idea. Or you might slow it down a little bit and spread that over a 10-year period. It's actually an 11-year period, but it's called GDS 10 years. And you can see that drops your depreciation in the first year down to $1,000, and the second year $1,800 and $1,440 in the next year, and then it's distributed over 2026 to 2033 at specific rates. These all have rates related to them that are in the IRS code. ADS, this one is a straight line method that we're looking at here, and it's going to be straight line over 15 years, and you're taking only half of the amount in 2023. And then 1/15 of the amount in years 24 through year 15, and in year 16, you're taking the other half amount. So you can see how that spreads the depreciation over a longer period of time and gives you some chances to recover some of those costs in later years and perhaps offset higher income levels. Next. Depreciation is reported on or determined on this form 4562. So you're not doing all these calculations on prior to entering, well, on a worksheet prior to putting it on a Schedule F. You're actually using another worksheet from your depreciation schedule, filing it onto the 4562, and then carrying that number over to the Schedule F. So work with the tax professional advisor when making these decisions, because these decisions are pretty critical and they'll impact your business for quite some time. Next. The other farm expense line is line 32, and you can see the kind of expenses that we might have and other farm expenses. These kinds of things aren't necessarily listed there in earlier expense categories. So advertising, dues and prescriptions, legal and professional fees is commonly a big one that you see here. You might have office expenses, tools that have a short life, obviously would be listed here. If you have startup expenses, which are associated with your farm, the startup expense deduction would be listed here. Business use of your home and any pre-production be period production expenses. Next. Expenses not reported on the Schedule F. You cannot, as the owner, charge for your labor, nor can you charge for any draws used for personal purposes, okay? Those are not deductible expenses for tax purposes. Your health and life insurance costs as the owner are not deductible. Principal payments on farm loans are not deductible. So why aren't they deductible? Because you're using the farm loans to buy something else, which is deductible, as well as the interest is being paid. Interest is deductible on farm loans. Market values of gifts and donations produced on the farm are not deductible. What you get to deduct is the costs that you have incurred in those production of those gifts or donations produced on the farm. So IRS says, okay, you didn't receive any income, that's fine. But you're allowed to deduct the cost you actually have into those items, not their value as gifts. Expenses that you would typically report on Schedule C are not reported on Schedule F, obviously. Schedule C is for other types of small businesses or for rental of real estate. You would not put any of those kinds of expenses on Schedule F. Okay, unless it's rental of, I should back that up. Okay, never mind. If anybody has a question about that rental, talk to me. Ask the question. Total expenses for this particular operation was $17,650. We had a farm profit of $7,800. And basically, most people that are in farming and are risking the fact that they have these assets in farming have all their investment at risk. And so you should be checking box A so that you can take that deduction. Next. So here's the summary of the profit and loss statement. There's the information that Kelly said on the top with respect to who's filing this return and how they're filing it and what the farm ID number is. Income from cash on a cash basis shows up there with line 9 at 25.5. Then a summary of expenses, expenses of 17,650 and net farm profit of 7,850. And that net farm profit gets carried over to the income form, which you're going to pay income tax on, and it gets carried over to a self-employment tax form, which you're also going to pay as a result of operating this business. Oops. Next. Remember, Kelly said that the sale of business property is not reported on Schedule F. It is reported on this form. This is probably one of the more common mistakes we see in a lot of people unfamiliar with preparing tax returns, is they'll place items like breeding cattle sales, horses that they use or oxen that they use for work in their business, hog sales, sour war sales, or ewe or ram sales here. I mean, and on their Schedule F. They don't belong on the Schedule F. They belong here. And the reason why you want to place them here is for a number of reasons. This is considered the sale of business property. Business property is not subject to self-employment tax. That's number one, any gain you have on this sale. So you're not going to pay self-employment tax with respect to these sales. The other thing is, if there's a gain, and if it's a long-term gain, it has a preferable tax treatment, which means it's going to be taxed at a much lower rate than your ordinary income. So those are two good reasons why when you're looking at your property in your farm, and you've disposed of it and received some money for it, make sure they do not go on Schedule F, but they get placed on the 4797 by the appropriate person preparing your return. Okay, and I think you're up next, right, Kelly?
Yes, that's right, Mike. So I'm just talking here about self-employment tax. And so when you have income from your farm, net income from your farm that you're reporting on your Form 1040, if you have $400 or more in earnings, then you will need to pay self-employment tax and file Schedule SE. So self-employment tax is the Medicare tax and the Social Security tax. So it's like you've got the employee half and the employer half. And when you are the owner operator, you are going to be paying both those amounts. So the two the employer and employee side of that together. Farm optional methods are available. And also, it's important to note here that self-employment tax does contribute to your Social Security and your Medicare. So if you are farming with a spouse, the spouse may elect to file as a joint venture and share that income for self-employment tax purposes. So that's really important when spouses are farming together and only one spouse is listed on the Schedule F, they get credit for that Social Security and Medicare. So it's important for spouses to understand there is an option for both spouses getting their credits. So filing estimated taxes. So when you have a tax liability, you must pay estimated tax if you expect to owe at least $1,000 in tax for the current tax year and expect that your withholding to be less than 90% of tax on the current year's return or 100% of the tax shown on the prior year's return. So I know that's a lot there, but just recognize that if you do have a tax liability, go through this checklist to determine if you are going to need to pay estimated taxes. And that would be owed in April, in June, in September, and then the following January.
Right. The option here is with farming, gross, yeah. Go ahead.
Did you want to say anything, Mike?
Yeah, if you go back to that prior slide real quick.
Yeah, good. Yep.
You don't have to file the, so that red section kind of pertains only to farming. That's one of the unique benefits associated with farming. If 2/3 of your gross income from the current prior year is from farming, then you're considered a farmer for purpose of filing estimated taxes. And that's all you have to do is one of those two items. Pay a single estimated tax of 2/3 of the tax due by January 15th of the following year and the remainder by April, or skip all the tax payments for that current year and pay them in March 1st. So most farm business, most other types of businesses have to pay this quarterly return, but farmers do have that option. But you have to meet that definition of a farmer for the purpose of filing estimated taxes. Sorry,
Thanks, Mike. Nope, no problem. Thanks. So here is the Form 1040 estimated payment instructions. So you would want to review that for how to make estimated payments if that does apply to you. And then, Mike, I think this is yours.
Yep.
Is that right?
Yeah, we just wanted to finish up
Great.
with a few kind of general slides, just sort of try to pull together, a little bit about your records and income tax reporting. So remember that sales of market livestock, crops, and other items purchased for resale, cost of items purchased for that resale reported in the year sold, even under the cash method. Sales of market livestock, crops, and other products grown or raised. This is going to come from your records from a lot of different categories. And this is going to be the biggest category that you're going to see on your Schedule F for most farms. And don't forget the other sections: agricultural program payments, patronage dividends, custom hire. You're going to receive a 1099 if it's appropriate. You want to make sure you place that information from that 1099 on your Schedule F if it's taxable, and then the other income section. Next. So on the expense categories, keep in mind that in the Schedule F, they do identify a lot of different expenses. Yeah, they are identified alphabetic. You might be beneficial to somehow tie those expense categories to the ones that you're keeping in your record system, so you can make an easy transition from QuickBooks to, does this belong under feed, or does this belong under fertilizer, or is this supplies, and all that other kind of good stuff. Make sure at the end of the year If you don't do it during the year, they allocate shared expenses between business and personal because personal expenses aren't deductible. You may have to adjust your loan payments to make sure that you correctly identify interest and business interest. And a couple expenses aren't allowed to be prepaid. Specifically, you can't prepay and deduct them on your Schedule F if it's prepaid interest, prepaid insurance, or prepaid property tax. Those are several expenses that are not allowed to be prepaid and deducted in a earlier year than when they're actually incurred. So it's a little different twist from cash, but it's only for those specific expenses. Correctly identify a subcontractor work versus hired employee wages. A lot of times people go to subcontractor. It's easier. They don't have to carry workers' comp. They don't have to do the filing returns. Make sure the person is a subcontractor and not your employee. Because if you mess that up, usually the State Department of Labor, as well as a couple other agencies, are very harsh. Next. Track all business expenses and transactions with regards to all your property. Keep track of what's happening. These things are set up in your capital accounts. Whether they're deducted all in 1 year or not, you still need a depreciation schedule that's going to feed into your depreciation form and your Schedule F from this list of property, and keeping track of what you spent and how much you spent and what's the remaining basis will all have impacts later on when you sell the property or somehow other dispose of it. So take time to carefully set up your chart of accounts for tax preparation as well as for making business decisions. And then the next one, Kelly. Lastly, there's a couple things we want you to check for. When you look at a farm accountant or a tax preparer, here's some general rules. Check their qualifications, make sure the preparer is available. Ask them about experience with family businesses. They may not have farm experience, but they might have experience with family businesses. It certainly would be beneficial if they had farm experience. Ask about their fees, how they handle areas that may be considered gray areas, areas where there's not clearly a well-defined law, but you might be able to take an extra expense, or are they going to represent you or support you with the IRS? If you have that gray area and you've taken out that expense. And then finally on this, if you click one more time, tips. Provide the person that's doing your taxes with the records and receipts. Review your tax forms before signing them. Never sign a blank tax return. That's a no-no. And make sure that your preparer signs and includes their taxpayer identification, their preparer tax identification number. Okay. And then lastly, go ahead, Kelly. Here's some sites you might want to look at. And I know you know the IRS site, but I'm not sure if you know some of those other sites within the IRS. I think the IRS site has become really good over the recent years. They've really done some good work and adding some additional links, if you will, or subsections of the site. They have a whole subsection on small business and self-employed individuals, and they have a section there on choosing a tax professional. The other organization does a lot of work with education and taxes, especially farm taxes, is Rural Tax Education. You can see their address there. And then USDA and then Ag FTAP is the organization that sponsored this particular presentation. And then lastly, thank you. And I guess we have a couple announcements. You want to handle those, Chris?
Yes, thank you so much, both of you. Mike and Kelly, this was great. And just so you know, we'll be sending an email with the resources that they've listed here, as well as the slides that they've presented today. So that will be some pretty good information. They talked about keeping good sales records, and we do have a QuickBooks for Farms training coming up starting March 4th. And it is about how to keep that good chart of accounts. So definitely check that out in our events. And if you want to know more information about what's coming up, you should sign up for our newsletter. We just send out one email a month talking about the different programming that's coming up having to do with new farmers. So go right to the Maine New Farmers Project website, extension.maine.edu/new farmers. And we also are both working off grant funding, and we would love for you to fill out our survey just so that we can report on who we're reaching today with this information. So I have that link in the chat, and that will also be in the email I send out. So thanks again, Mike and Kelly. We are out of time. So if you have any questions, feel free to email me directly. Or you can email either of our speakers, and their email address is right there. Thank you so much for attending, and we hope to see you at another one of these webinars. We have another one coming up the first week in February.